Welcome back, everybody, to another episode of the Passive Income Lifestyle Series. I'm your host, Travis Watts, the Director of Investor Education here at Ashcroft Capital. Got a very exciting episode for you today. What we're talking about is printing money and real estate and the opportunity of a lifetime. Disclaimers as always, never financial advice, not going to tell you or anyone else what to do with your money. So please always seek licensed financial advice. So let's kick it off and get started. I want to ask you a quick question. Did you know that the purchasing power of the US dollar has fallen by nearly 90% since 1950? Even crazier, the purchasing power of the US dollar fell nearly 7.4% just between the years 2021 and 2022. And that's right off the website of the Bureau of Labor Statistics. And by the way, on a quick side note, if you ever want to see how the US dollar is holding up relative to other currencies around the world, there's actually an index for that, and it's called the DXY index. And you can simply Google that and check out a chart to see more about what we're talking about here. But the basic concept here comes from Economics 101. When you increase the supply of something, the value goes down. But I want to share with you in this short episode why this may not be such a bad thing for real estate investors. You see, most real estate investors, statistically speaking, use some form of debt or leverage to purchase properties. So we'll take an example of $1 million property. You're looking to purchase that. You decide you're going to put 30% down as down payment. That means you're going to borrow the rest from the lender or from the bank. So in that example, that would be $700,000 of debt in today's dollar valuations. And the cool part about that is if you hold on to that property long term, you can actually have your renters pay down that debt for you as rents and inflation increase moving forward. So our national debt in America right now is exceeding $30 trillion. So what does that tell you and I? Well, simply put, it means our government doesn't have enough money to pay for its current obligations, things like Social Security and the entitlement programs that we have, much less what all the politicians are talking about right now are things like student loan forgiveness or bank bailouts or UBI, which is universal basic income. If these things decide to roll out, that's going to cause more printing of money. That's going to increase the national debt. That's going to be inflationary, and that's the bad news. So what's the good news as a real estate investor? Well, think about it this way. If you had 1 million goods in an economy, and in that same economy, there was $10 million in circulation, that means that the price per good would be $10. But if you increase the money in circulation, so you still have 1 million goods, but now you have $20 million in circulation, the cost per good goes up to $20. So if you're buying property today or you already own property with fixed rate debt and it's cash flow positive, it may be in your best interest to hold on to those properties for the foreseeable future, because effectively that debt is getting cheaper to pay off the longer you hold the property. See, when we have inflation, wages go up. And as renters have more money, they can afford to pay higher rents, which is why rents often go up at the same time. For example, the median U.S. household income in 2011 was around $50,000. Fast forward 10 years later, and it's nearing $70,000. So that's nearly a 30% increase over a 10-year time frame. But remember, inflation didn't really start to kick off here in the US until 2022, where it spiked out at 9% over that summer. In a similar example, apartment rents in 2013 were around $1,200 per month. Fast forward a decade through today, apartment rents nationwide are averaging about $1,700 per month. Again, about a 30% increase over the past decade. So where's the future going to take us? Well, I don't have a crystal ball. I don't have that answer for you, but I will say we can certainly learn some lessons from history. So right now in 2023, if you're looking to invest in real estate, it's not uncommon in the commercial multifamily space to be seeing discounts on properties relative to pricing a couple years ago at around 20%. So this presents an opportunity to buy the dip, to lock in fixed rate debt, and to hold properties for the long term. You're listening to the Passive Income Lifestyle Series right here at Ashcroft Capital. If you'd like to learn more about current offerings and opportunities, you can visit ashcroftcapital.com or reach out to myself, Travis, at ashcroftcapital.com. I'd be happy to be a mentor, a resource, or help you with any questions that you have. Thank you so much for tuning in to this episode. Have a great week, and we'll see you next time.